Welcome, good morning, and welcome to Global Money Talk. This morning we have with us Mark Newton, Global Head of Technical Strategy at FundStrat, and just the man that we need in these times. So, I was just saying before we started, the times that try men's soul. As a technician, I think you're the perfect person to tell us, what's important right now, because valuations really don't matter. So what we've seen in the 2 days since Tariff Liberation Day, and we're continuing to see overnight in Asia, and a bit, as we've started this morning, is there is absolute panic in the markets, in the stock markets certainly. Not so much the other market, but in the stock markets. And what are you looking at in terms of technical indicators to see where we might be nearing the bottom, or that there may be further going? Like, what indicators are you looking at right now?
Thank you very much for having me here today. It's been an incredible unwinding of market capitalization literally in just the 3 days. We've had the greatest 3-day drop at this point since World War II. This is second really to the great financial crisis of 2008. It's actually greater than what we saw during COVID in 2020. Wow. So we stand as of now down about 13% just in 3 days' time, which makes trying to pick bottoms incredibly difficult. As Americans, we try to leave that to the proctologists, not to ourselves. It's interesting. I look at things like breadth and oversold conditions. Those are, honestly matter very little during times of severe volatility to the downside. Honestly, when you look at a decline of this sort, it is important to understand the ranges to try to put things into perspective. Looking at weekly charts, monthly charts, you see that the S&P is now approaching a 50% retracement to the entire rally from 2022 into February of 2025 this year. This level also roughly lines up with the prior peak in early 2022 in January. So there is an argument to be made that we are approaching a short-term low to this recent setback. We've had an extreme unwinding of breadth that is now approaching lows that we saw back in 2022, along with 2008, 2009. Percentage of stocks below their 20-day moving average has moved down to 5%. So extreme downside breadth that normally means that we're getting very, very close to a short-term market bottom. Normally, I look for evidence of capitulation in the decline. We have seen evidence of this to some extent. Equity put to call ratios are now over 1, meaning there's an equal level of puts being bought to level of calls. Normally this happens near market bottoms. The VIX is showing severe term structure inversion, meaning the spot VIX is much higher than the 3-month future. That normally also can happen near market bottom. What I personally would like to see is an overbalance of volume to the downside, meaning a high TRIN, or what they call the ARMS index. When this gets to 2.5, that normally can signal an excessive amount of selling compared to the advanced decline, huge volume on the downside that normally coincides with the market bottom. But make no mistake, we are certainly in an uncertain time that it makes it very difficult to simply say buy the dip and that everything's going to be fine. Much of my thinking about the market is going to depend on the extent of the bounce that we see in the months ahead. If I have to make a short-term prediction, I think that markets bottom within the week on a short-term basis, which means largely by April 13th to the 15th, which is next week. The wave structure of the move does not look complete right now. Gaps, like we've seen, normally represent wave 3s from an Elliott wave perspective. So ideally, markets should bottom between today and Wednesday, attempt a small bounce, and then we make a final flush out to the downside, which could represent a low. I'm speaking very technically, and I hope that's okay, but there's obviously things that I look at that are different from the macro environment or earnings or the economy. None of that really matters in terms of markets at this point. We all want to see some relief in the tariffs, hoping that there is some negotiation that would be seen as favorable to what has been announced in the last couple of weeks. Unfortunately, good news rarely happens at bottoms. That's an important point. Bottoms happen when you see either a drying up of selling on the downside or mass capitulation where things have gotten so bad, extreme volume selling, where everybody is so fearful and the sentiment turns very pessimistic very quickly. Arguably, we're there on that second point. So, the recent selling started out being orderly but concentrated, and just in the last week has turned more broad-based, where almost all countries are now being affected, and they're all starting to come down very rapidly. That also is a change in the character of the selling.
Is there any way to tell in the character of the charts and the momentum whether whether selling is actually long capitulation, or is it these programs or programs that are selling aggressively because they feel that there is more downside? Can you tell any sense to see whether it's people going short, quote unquote, or this is actually long-term longs actually capitulating?
That's a great question, and I don't think there's any easy answer to that. What started out as being rather orderly has grown into more of a full-fledged panic in recent days. We did see evidence of bearish sentiment even back towards the latter part of February and throughout March, where people were very negative on a retail level, and just in the last week that has grown into more institutional bearishness as well. Many firms have reduced their targets for the year, but difficult to say with a lot of precision after very extreme selling and just in the last 3 days that this is exactly retail or institutional, or that's very difficult to know.
I guess everybody's sort of looking at the S&P 500 as sort of the index, right? The broad index. Is this a good time to be a little more granular in terms of you may have some really good names? Are they, I guess they call throwing out the baby with the bathwater? Is this a time to look for specific quality names that ought to be owned, and then take this as an opportunity to buy those names, because you think that those will be strong names in the longer term, and taking advantage of this drawdown? Is it a good time to be a little granular, like looking for quality that's getting hurt in this entire move?
Generally, we've seen very low correlation over the last couple months, despite the selling, which has been a bit unusual for me, meaning that this is a good stock picking environment. That has gradually started to lift in the last week, meaning that more things are starting to decline all at once. I do believe that this is a good opportunity for those that have a long-term time frame and also a proper risk tolerance to buy stock. However, in the short run, it's still extraordinarily volatile, and there's no guarantee that we're bottoming right away. So I would say for those that have a longer term time frame, it is the right time to look at those names. We've seen valuations come more in line in the last few weeks. Technology is still going to represent 25% of the earnings growth for 2025. So that is the profit center for the US for this year. However, we also know that the Magnificent Seven in most of large cap technology were a huge overweight, as they say, a crowded trade in the US really over the last 6 months. That's where the majority of money has been invested, not only from the US but also abroad. These are companies that have all made our lives better. However, we're seeing a very big unwinding to that just in recent days. I like the US. It still maintains a 20-year uptrend versus the rest of the world. So we've seen about a 4-month underperformance now of the US versus the world, which is highly unusual given that the tariffs are being directed at all these other countries, but yet it's in the US it's lost the most ground, not other countries. So I find the US to be compelling for long term, but as to whether you recommend to people to dive in and buy stock, assuming you've been underweight the US, a lot of it depends on one's own investment frame and time frame and your own risk tolerance as to whether that's a good move.
You mentioned sort of comparing the U.S. with some of the other countries, and if you look at some of the European sort of broad averages, I think the DAX, the German stocks were up sort of 15% in less than a quarter. I think they're probably corrected a little bit now. Do you see sort of opportunities in some of the other broad indexes where whether they're in Europe or elsewhere in Asia that might be a good sort of place a safe haven, or at the beginning of you mentioned that the U.S. is is still in a long-term uptrend. Do you see opportunities elsewhere in the world where it might be a change of allocation, but indices elsewhere in the world that might be attractive?
I certainly feel there are opportunities abroad for those that are seeking diversification outside of U.S. stocks. Areas within Europe, areas within emerging markets, given the decline in the U.S. dollar, are actually quite attractive this year, despite the recent turmoil and volatility. I like Mexico, I like India, and honestly, I like buying dips in China in the short run, given this pullback. And I think Japan is also quite attractive for a number of different reasons. For those that need more of a safe haven, defensive sectors make a lot of sense, like utilities and healthcare. And treasuries at this point are still much more of a safe haven in the short run than U.S. technology. And finally, I think gold makes a lot of sense. I think that we're still in a rate cutting cycle. Gold has acted phenomenally well. It shows no real technical evidence of rolling over. So there certainly are some opportunities. However, in conclusion, all these assets likely work for short term only versus the US, meaning the next 1 or 2 months. I think if you have a long-term time frame, it is right to buy and hold U.S. technology at current levels.
You mentioned some of the other markets, and I do want to talk about some of the other markets, because the world isn't just stocks, and certainly not just U.S. stocks. But I want to talk about bonds, and they've had a pretty good rally. Certainly, I looked at U.S. Treasuries, and I haven't looked at sort of other fixed income instruments. But at a glance, what are you thinking of the U.S. Treasury market? Can sort of continue additional strength, or are we starting to lose a little momentum there? How are you looking at the sort of the 2 years, and 10 years in the curve? What are you thinking?
We've seen a pretty rapid steepening in the curve, which makes sense given not only the growth scare but also the potential for inflation to come down sharply. So the Fed may be adding additional cuts into the curve has caused the 2-year to start to pull back, 2-year yield to pull back much more sharply than the 10-year. So that steepening has been continuing. I think the entire curve continues to fall over the next 6 months, but I think it's going to be a choppier market given the progress that we've made already. I would favor buying equities over treasuries here, given the opportunity. I think that the 10-year being down under 4% is a little bit higher risk investment. And so I feel that it's more of a short-term trade only for safety reasons rather than thinking that yields can come down too much more from where they're at. My target for the beginning of the year for 10-year was at 3.5%, and it's already getting a lot closer than that, only about 40 basis points away. So, I think in general, it's interesting. We have seen junk spreads gradually start to lift the last week that had been largely contained before, meaning that we hadn't seen any evidence of dislocation in the fixed income market. And so all of a sudden now that has started, but arguably junk bonds, are still somewhat attractive, and we haven't seen spreads blow out to the extent that we had during other bear markets. So I find that to be encouraging in some extent. If this is a bear market, it's not being driven by dislocation in fixed income. And normally that almost always happens ahead of big market turns down. You see the fixed income market freeze up and start to show huge spread widening. And honestly, the level that's happened has been minor this time compared to prior times of volatility.
That's a good point. We've seen in our careers so many disasters, almost always all begin and end with fixed income. Right. This time does not seem to be the case. Right. I want to touch on the currency markets. And the currency markets have actually been sort of relatively calm on a relative basis. You had that initial surge in euro, which retraced. The yen strengthened, everybody's favorite, sort of anti-dollar strategy, but then it sort of stopped. And are the currency moves, or sort of a lack of the big moves, telling you anything, or do you see any, sort of specific opportunities, particularly, let's say, in the dollar index or something like that? But I was a little surprised that we've gotten relatively modest volatility in currencies.
To me, it looks like the dollar has followed treasury yields down and now should be beginning to stabilize over the next couple of weeks and begin a bounce. However, I do feel that the US dollar still has a lengthy decline ahead of it between now and probably year end before we can start to stabilize and strengthen. So when I look at the currencies against the dollar, I still like the yen quite a bit. I feel the yen can rally up to 139 versus the dollar, which is down near prior lows. I think the dollar index DXY eventually will undercut the lows that we're seeing last fall before we start to see a period of rally. The bottom line is if we're truly going to see a growth scare and we're heading into a recession, which for me is still very unclear, the US should stand up and be better than most other countries. And so I would expect to see dollar strength in the years to come versus the euro, versus sterling, versus yen. But the yen is an unusual circumstance given the inflation with Japan. Japan's one of the few countries in the world that's hiking rates at a time when everybody else is cutting. So, I still see that as being potentially a safe haven trade right now with the recent downside volatility in dollar yen in the last 2 weeks, along with things like Swiss franc. The dollar already had unwound quite a bit prior to this recent period of volatility in equities. And so we'd already seen yields and the dollar retreat. And I think we're getting closer to at least a short-term bottom as part of an intermediate term decline in the dollar.
I'm trying to think of the DXY chart in my head, and I think 112 or thereabouts was the high. We're down to 102 or thereabouts now. The low that I'm thinking about is 90. Do you think we'll get down to that 90-ish range before it's all said and done? That might be a couple years back, though.
I'm not certain of the levels, but I would look at last fall's lows, which I think might have been near 98 potentially. I think that will be eventually tested sometime into this fall. So if we're going to see persistent dollar weakness, that's a great environment for emerging markets, assuming we can see some stabilization in the current volatility. But I think in general, one can certainly look at dollar weakness this year, but gradually that the dollar will probably start to strengthen into early next year.
You mentioned gold a little bit earlier, and we did have a bit of a sharp correction in silver actually, and they rebounded. And you said or at least the gold chart doesn't look like it's rolling over at all in any serious way. The other thing I want you to expand a little bit on is copper had quite the move. It was up, in my mind, the LME, sort of 10,000, and now it's at sort of under 9,000. In the metals or oil, because oil had that that double whammy when this announcement came out and OPEC said, well, we'll add another 400,000 barrels, and so they had quite the drawdown in oil. So views on base metals, particularly copper and oil.
Let's start with the second part of your question first. I'm very bearish on crude oil this year. Over the next 6 months, I think crude likely gets down under 50 and potentially down to the mid-40s before it stabilizes. That's a combination not only of increased U.S. infrastructure, meaning we're going to be potentially drilling up to 3 million barrels more a day in the U.S., and also the fact that OPEC Plus has just added capacity and has been increasing their own supply. That is coupled with a fragile Chinese recovery that should have negative implications on demand for China. And now that the tariff cloud is hanging over the world as a whole, the demand picture is likely going to be down for the foreseeable months. So I do think that is a big negative for crude oil. It recently undercut levels in the mid-60s that went back over the last year. So technically it's a big breakdown that literally has just started based on the last 2 days. I'm underweight energy. I've discussed that with clients, and that's something that I think you have to have real patience on, despite this sector looking cheap, because crude is still in the midst of a very violent decline. That's part one.
Yeah.
Part two is the metals. The recent severity of the decline in copper and in many base metals and industrial metals like silver, it is a little bit of a concern to me. Those move based on demand. So it's largely the same trade as crude, but I have a little bit more optimism on silver and copper than I do crude oil in the short run. So I feel that it is right to buy dips in both silver and copper. We've had a substantial decline in both of those in recent days that has been far worse than what we saw in precious metals like gold. One could argue that gold might be the so-called safety trade, whereas silver and copper are more heavily tied to China than gold potentially. So that is probably a reason for the near-term weakness. But I still think that looking out over the next year, it's going to be right to own, silver and copper.
I want to talk a little bit about crypto. And late last year, you had the most beautiful, perfect call on crypto ever. Called the high, you called the bounce, and now for Bitcoin was hanging around 80,000 very quietly, and then it corrected sharply over the weekend. And some of the other coins, I think Solana had quite a sharp drop as well. What charts are in crypto are standing out to you, and what are your thoughts on the space?
Since the last time we've spoken, I made mention that the Bitcoin cycle had bottomed in the middle part of March. And so we've seen some evidence of correlation unwinding between the NASDAQ and Bitcoin in recent weeks. Cryptocurrencies like Bitcoin have held up better than US equities and equities in most of the world. Bitcoin had bottomed right near 76,000 and risen to the mid 80s. And in the last couple of days, we've started to retreat, but we're still above those levels as of now. That we're seeing back in the middle part of March. My thinking is Bitcoin is a good investment between now and October. I do think that crypto can have a pretty strong bounce. However, I'm unclear as to whether this kicks off a lengthy bull market for Bitcoin. We still seem to be in a very choppy environment, but still early in this current cycle. So I'm expecting that Bitcoin rises and gets back to above recent highs at 108,000. It probably gets to 125 to 135 into the fall. And at that time, I would consider selling it. That's an aggressive call given the world and potentially the drying up of liquidity as we know it. So it's interesting. If Bitcoin gets under 76,000, then we probably do see a final flush to 60. That's not my base case, but I would be an owner of Bitcoin specifically because the correlation versus the rest of the world has started to unwind, and I feel it makes a good call for diversifying, albeit in a very volatile one.
This is tough questions, but you're sort of the expert in this. I'm going to throw them at you. In terms of, you said that for the S&P 500, we should get, presumably momentum-wise, maybe a short-term low by perhaps next week, and then a bounce, and then we'll have to sort everything out. So the question there is, I hate to ask it, but the low of lows, roughly where do you think, from what we can see now, where do you think that might be? And how long before, volatility can't stay, the VIX can't stay above 30 forever. And I think you mentioned the VIX is, quite backward dated now. In terms of these market dislocations, do you have a sense of when does this actually sort of calm down? Well, actually, three-part question. Roughly the low of lows in the S&P, where the bounce you think we get up to, and when does it finally, this volatility exhausts itself?
This is all very tricky to analyze in the short run, given the volatility. But I feel like 4,800 to me is a very important level for the S&P. And so I feel that probably holds for April. And if it's undercut, it shouldn't be by much before the market likely rebounds to potentially 5,500. The participation, the wave structure, the character of the advance are all important towards gauging whether this is a bounce as part of a bear market that's going to continue in the second half of this year, or whether we can start a much larger rally. I feel we're very close in the short run. I don't have any precise targets. I feel that between now and mid-May, if I'm wrong on April, then it very well, we have about a month where the market's going to be in a bottoming process, and I expect it to be very volatile. But the direction should be higher between the spring and the summer, and we should have probably at least a 3-month rally, and that's going to be decision time as to whether investors want to use that to hedge, to sell, to diversify outside the US into other areas. Very difficult to make that decision, right now. I think that there's enough signs for me that I want to hold my nose and buy, regardless if 4,800 holds, because I think that we are going to bottom out. But I'm very discouraged by the deterioration we've seen, and so I just want to have certainty as well as everybody. We've seen a real rolling over in momentum, and that is problematic to have occurred in such a short time frame as we have. Difficult for me to say buy and everything's going to be fine, and I also don't want to be a real seller here. Important, we need to see that stabilization. I would love to see more evidence of capitulation. I don't have an easy downside target for you under 4,800. I think retracing, my guess would be 61.8% of the whole move from 2022 to 2025 which is slightly under 4,800. I think it's around 4,500. If I had to say that, that would be my call for, where this bottoms.
Last question, 61.25. Is that a medium-term high for a real long time?
61.25.
So, sorry, the high for the
50,
S&P.
yeah.
Oh, yeah.
Rebounding to, I think that the area of the open gap was at 5,500 for the S&P. The gap is going to be the area that has the most significance on a rally in the months to come. If we can get above that, we can start talking about a movement potentially back to new all-time highs in 66.50. I'm unwilling at this time to say this is just either a bear market or a drop in the bucket. Much is going to happen in the next few weeks that will give me a lot more confidence on where we are in the cycle and what is to come.
Oh, thank you so much, Mark. Really, I think we will want to be talking to you often in the coming days and weeks. Thanks again.
Happy to join you. Thank you very much, Ty.
Yeah, so the question was, you mentioned that in the long term, the market will correct and it will go in a stable period. But she believes that the tariff is mostly directed to China in order to make their strengthen their economy or gain power dynamics. So the question is whether you see that market will correct due to Trump will make some negotiation with China and lower their tariffs, or is it because the market will adapt to the tariff and it will correct naturally? So which side do you think the U.S. and China relationship will come?
It's a tricky time. We all know Trump to be a very transactional president. It's all based on the art of the deal. You scratch my back, I'll scratch yours. I don't think any of us know for certain how this is all going to, what the end game for this will materialize. I am hopeful that we'll see negotiation that would, 50 countries have approached the U.S. already, but really, I have some real problems with the math on how the tariffs were decided to be levied against all these countries. I think it's really unclear, and that lack of clarity is what's causing the volatility right now. China has already corrected probably 20% in the last couple of weeks off the earlier highs. So based on things like FXI or KWEB or any of the popular ETFs have already pulled back substantially. I think that's in an interesting spot, and I honestly think that the majority of the damage has been done in the short run, and one can buy into China.
There were two questions, so I'll just go one by one. The first question is, where do you think the bottom line of the Bitcoin will be? Do you think it will fall further, or it doesn't have to be exact, but what do you think of the range of the bottom line of the Bitcoin right now?
I think the bottom will be 60,000 on this current cycle, and the top will probably be 130,000. We're getting very close to the bottom, and it might have already bottomed at 76,000. So I like being long between now and October over the next 6 months. So I think it's going to go higher, but I'm unwilling to say that it's going to go to 250 or a million. I think that's very, very difficult. We're still in a cycle where we could have further weakness into the fourth quarter or into 2026. For now, all I can call for is really a bounce that I think lasts maybe 3 to 5 months.
And the second question was, you think that several indicators in the market doesn't really represent the current market situation right now. So what is your judgment of classifying that certain indicators don't really represent the market very well? Is there any standards that you make judgments?
Technical analysis is always quite valuable in showing uptrends, downtrends, and sideways trends. As to how one uses those is all based on your own time frame and methodology. So I still find using technicals to be extraordinarily useful in times like this, showing that we're in a short-term downtrend, but yet most of the longer-term trends are still intact. The final answer to your question is during rapid volatility, finding support or resistance is often quite difficult. And so do indicators work not as well? I think it depends on what indicators you're using, and I think that trying to pick a bottom during any violent decline is very, very difficult, and you have to wait for more evidence of stabilization. That doesn't mean the indicator doesn't work. It just means you have to understand the context of the decline as part of the broader range, if that makes sense.